Free Banking versus Large-Scale Credit Expansion by Ludwig von Mises. This article is excerpted from Chapter 17 of Human Action, the Scholar's Edition, and is read by Jeff Riggenbach.
Observations on the discussions concerning free banking. The banking school taught that an overissuance of banknotes is impossible if the bank limits its business to the granting of short-term loans. When the loan is paid back at maturity, the banknotes return to the bank and thus disappear from the market. However, this happens only if the bank restricts the amount of credits granted. But even then, it would not undo the effects of its previous credit expansion. It would merely add to it the effects of a later credit contraction. The regular course of affairs is that the bank replaces the bills expired and paid back by discounting new bills of exchange. Then, to the amount of banknotes withdrawn from the market by the repayment of the earlier loan, there corresponds an amount of newly issued banknotes. The concatenation which sets a limit to credit expansion under a system of free banking works in a different way. It has no reference whatever to the process which this so-called principle of Fullerton has in mind. It is brought about by the fact that credit expansion in itself does not expand a bank's clientele, namely, the number of people who assign to the demand claims against this bank the character of money substitutes. Since the overissuance of fiduciary media on the part of one bank, as has been shown above, increases the amount to be paid by the expanding bank's clients to other people, it increases concomitantly the demand for the redemption of its money substitutes. It thus forces the expanding bank back to a restraint. This fact was never questioned with regard to demand deposits subject to check. It is obvious that an expanding bank would very soon find itself in a difficult position in clearing with other banks. However, people sometimes maintain that things are different as far as banknotes are concerned. In dealing with the problems of money substitutes, Catalactics maintains that the claims in question are dealt with by a number of people, like money, that they are, like money, given away and received in transactions and kept in cash holdings. Everything that Catalactics asserts with regard to money substitutes presupposes this state of affairs. But it would be preposterous to believe that every banknote issued by any bank really becomes a money substitute. What makes a banknote a money substitute is the special kind of goodwill of the issuing bank. The slightest doubt concerning the bank's ability or willingness to redeem every banknote without any delay at any time and with no expense to the bearer impairs this special goodwill and removes the banknote's character as a money substitute. We may assume that everybody not only is prepared to get such questionable banknotes as a loan, but also prefers to receive them as payment instead of waiting longer. But if any doubts exist concerning their prime character, people will hurry to get rid of them as soon as possible. They will keep in their cash holdings money and such money substitutes as they consider perfectly safe, and will dispose of the suspect banknotes. These banknotes will be traded at a discount, and this fact will carry them back to the issuing bank, which alone is bound to redeem them at their full face value. The issue can still better be clarified by reviewing banking conditions in continental Europe. Here, the commercial banks were free from any limitation concerning the amount of deposits subject to check. They would have been in a position to grant circulation credit and thus expand credit by adopting the methods applied by the banks of the Anglo-Saxon countries. However, the public was not ready to treat such bank deposits as money substitutes. As a rule, a man who received a check cashed it immediately and thereby withdrew the amount from the bank. It was impossible for a commercial bank to lend, except for negligible sums, by crediting the debtor's account. As soon as the debtor wrote out a check, a withdrawal of the amount concerned from the bank resulted. Only a small group of big business treated deposits with the country's central bank of issue, not those with the commercial banks, as money substitutes. Although the central banks in most of these countries were not submitted to any legal restrictions with regard to their deposit business, they were prevented from using it as a vehicle of large-scale credit expansion because the clientele for deposit currency was too small. Banknotes were practically the sole instrument of circulation credit and credit expansion. Similar conditions prevailed and for the most part still prevail by and large in all countries of the world which are outside the pale of Anglo-Saxon banking methods. In the 80s of the 19th century, the Austrian government embarked upon a project of popularizing checkbook money by establishing a checking account department with the Post Office Savings Service. It succeeded to some degree. Balances with this department of the post office were treated as money substitutes by a clientele which was broader than that of the checking account department of the country's central bank of issue. The system was later preserved by the new states, which in 1918 succeeded the Habsburg Empire. It has also been adopted by many other European nations, for instance, Germany. It is important to realize that this kind of deposit currency was a purely governmental venture, and that the circulation credit that the system granted was exclusively lent to the governments. It is characteristic that the name of the Austrian Post Office Savings Institution, and likewise of most of its foreign replicas, was not Savings Bank, but Savings Office. Apart from these demand deposits with the government post system in most of the non-Anglo-Saxon countries, banknotes, and, to a small extent, also deposits with the government-controlled central bank of issue, are the only vehicles of circulation credit. In speaking of credit expansion with regard to these countries, one refers almost entirely to banknotes. In the United States, many employers pay salaries and even wages by writing out checks. As far as the payees immediately cash the checks received and withdraw the whole amount from the bank, the method means merely that the onerous burden of manipulating coins and banknotes is shifted from the employer's cashier to the bank's cashier. It has no catalactic implications. If all citizens were to deal in this way with checks received, the deposits would not be money substitutes, and could not be used as instruments of circulation credit. It is solely the fact that a considerable part of the public looks upon deposits as money substitutes that makes them what is popularly called checkbook money, or deposit currency. It is a mistake to associate with the notion of free banking the image of a state of affairs under which everybody is free to issue banknotes and to cheat the public ad libitum. People often refer to the dictum of an anonymous American quoted by Tooke: "Free trade in banking is free trade in swindling." However, freedom in the issuance of banknotes would have narrowed down the use of banknotes considerably if it had not entirely suppressed it. It was this idea which Czerniewski advanced in the hearings of the French banking inquiry on October 24, 1865. I believe that what is called freedom of banking would result in a total suppression of banknotes in France. I want to give everybody the right to issue banknotes so that nobody should take any banknotes any longer. People may uphold the opinion that banknotes are more handy than coins, and that considerations of convenience recommend their use. As far as this is the case, the public would be prepared to pay a premium for the avoidance of the inconveniences involved in carrying a heavy weight of coins in their pockets. Thus, in earlier days, banknotes issued by banks of unquestionable solvency stood at a slight premium as against metallic currency. Thus, travelers' checks are rather popular, although the bank issuing them charges a commission for their issuance. But all this has no reference whatever to the problem in question. It does not provide a justification for the policies urging the public to resort to the use of banknotes. Governments did not foster the use of banknotes in order to avoid inconvenience to ladies shopping. Their idea was to lower the rate of interest and to open a source of cheap credit to their treasuries. In their eyes, the increase in the quantity of fiduciary media was a means of promoting welfare. Banknotes are not indispensable. All the economic achievements of capitalism would have been accomplished if they had never existed. Besides, deposit currency can do all the things banknotes do, and government interference with the deposits of commercial banks cannot be justified by the hypocritical pretext that poor ignorant wage earners and farmers must be protected against wicked bankers. But, some people may ask, what about a cartel of the commercial banks? Could not the banks collude for the sake of a boundless expansion of their issuance of fiduciary media? The objection is preposterous. As long as the public is not, by government interference, deprived of the right of withdrawing its deposits, no bank can risk its own goodwill by collusion with banks whose goodwill is not so high as its own. One must not forget that every bank issuing fiduciary media is in a rather precarious position. Its most valuable asset is its reputation. It must go bankrupt as soon as doubts arise concerning its perfect trustworthiness and solvency. It would be suicidal for a bank of good standing to link its name with that of other banks with a poorer goodwill. Under free banking, a cartel of the banks would destroy the country's whole banking system. It would not serve the interests of any bank. For the most part, the banks of good repute are blamed for their conservatism and their reluctance to expand credit. In the eyes of people not deserving of credit, such restraint appears as a vice. But it is the first and supreme rule for the conduct of banking operations under free banking. It is extremely difficult for our contemporaries to conceive of the conditions of free banking because they take government interference with banking for granted and as necessary. However, one must remember that this government interference was based on the erroneous assumption that credit expansion is a proper means of lowering the rate of interest permanently and without harm to anybody but the callous capitalists. The governments interfered precisely because they knew that free banking keeps credit expansion within narrow limits. Economists may be right in asserting that the present state of banking makes government interference with banking problems advisable, but this present state of banking is not the outcome of the operation of the unhampered market economy. It is a product of the various governments' attempts to bring about the conditions required for large-scale credit expansion. If the governments had never interfered, the use of banknotes and of deposit currency would be limited to those strata of the population who know very well how to distinguish between solvent and insolvent banks. No large-scale credit expansion would have been possible. The governments alone are responsible for the spread of the superstitious awe with which the common man looks upon every bit of paper upon which the Treasury or agencies which it controls have printed the magical words, legal tender. Government interference with the present state of banking affairs could be justified if its aim were to liquidate the unsatisfactory conditions by preventing, or at least seriously restricting, any further credit expansion. In fact, the chief objective of present-day government interference is to intensify further credit expansion. This policy is doomed to failure. sooner or later, it must result in a catastrophe.